Hi all, welcome to this session. In this today's session, we are going to discuss about the liabilities, its recognition and classification. In the previous session, we started from the balance sheet and we covered the asset. Now we are into liabilities. How a liability is recognizing and how the liabilities are classified. Before going to our discussion, imagine you are part of a finance team in a company. At the month end, the company has received some advance payment from the customers. There are some unpaid supplier invoices and ongoing legal cases. Suppose at the end, there are some advance payments that you have received from your customers. You have received some advance payment, and there are some unpaid supplier invoices. Supplier supplied you that material, but you didn't pay that invoices, and an ongoing legal case that may cause some disputes or liabilities in the future. So at that particular moment, how you are measuring your liability, how you are measuring or presenting your total liabilities in the financial statements, how you are reflecting these cases in your financial statement, which is directly going to affect your financial position reporting and the investor confidence and short-term liquidity analysis, how you are analyzing your short-term liquidity. All these things will getting affected by how you are treating these cases in your financial report or financial statement. This is about liability recognition, how you are recognizing the liabilities based on some cases, the advance payment you receive from the customer, and the legal cases ongoing, and there are some unpaid supplier invoices are there. How you are treating these in your financial statement will determine your financial position reporting, your investor confidence, and your short-term liquidity. So this is why the liability classification of liabilities and its recognition is become very critical and very important in a financial statement. So let's get started. So what is a liability? A liability is a present obligation arising from the past event and that required outflow of economic resources, cash, goods or services in the future. That is a liability. First thing, it should be a present obligation and it has arisen from a past event and required outflow of some economic resources like cash, goods or services in the future. In simple terms, if the company cannot avoid paying or performing, it has a liability. If a company cannot avoid paying or performing something, that has a liability. This concept ensures that accurate financial reporting, transparent disclosure of obligation, and better decision making by stakeholders. So this is a liability. It is arising from a past event and required outflow of economic resources. Suppose if a company plans to hire employee next month, is that a liability today? No, it's not a liability today because there is no present obligation if you decided to hire an employee next month. If a customer pay in advance, has this earned revenue yet? If some customer pay an advance for you, still you didn't supply that material to customer, so it's a earned revenue? No, it's not an earned revenue. The revenue recognition happens only once you are transferring that material to customers. Once you receive some advance payment from the customers, it's not a revenue, it's a liability for you because you have to perform that obligation in the future. Should a company record a liability for lawsuit that might happen? Suppose there are some lawsuit happening in the court. So which companies are expecting to happen, might to happen that lawsuit. So this has to be recorded as a liability. Yes, this has to be recorded as a liability. because this might happen in the future. How would misclassifying liabilities affect financial ratios like current ratio? If you are misclassifying a long-term liability as a short-term liability or current liabilities, yeah, definitely which will going to affect the liquidities ratios like current ratio, even the long-term solvency are also going to affect, because you are classifying a long-term asset as long-term liabilities as current liability. So definitely which is going to affect your liquidity ratios. So the recognition criteria, how we are going to recognize a liability. A liability is recognized only when probable and measurable. It should be probable and it should be measurable also. Probable means outflow of resources is likely. And measurable means amount can be reasonably estimated. If you meet this criteria, then only the liability is going to measure or recognize. Why this matter in the corporate finance? First thing, it is going to impact the working capital management. If you recognize something as a liability or a current liabilities, which is going to affect the working capital, and which is going to affect the credit worthiness and borrowing capacity. If you are recognizing something as a long-term liabilities, which is going to affect your credit worthiness and which is going to affect your borrowing capacity also. Then which is going to affect the financial ratios like current ratio, quick ratio, debt ratio, all these ratio going to affect if you are recognizing something as a liabilities. Again, which drive the investors and lender decision making. Based on the current liabilities or the long-term liabilities, the investor or the lenders has to make decision on their lending and investing decisions. So this will drive the decision making process by lenders or investor. The accrual concept link. There is a accrual concept in the accounting. That means accrual accounting means directly liabilities are closely linked to accrual accounting, which ensure that expenses are recorded when incurred, not when cash is paid. What is accrual accounting principle? That means revenue is recognized when the revenue is earned, not based on the cash inflow. And at the same time, the expenses also recognized when the expenses are occurred, not based on the cash outflow. This is accrual principle. So the liabilities recognition is closely linked with the accrual concept as well. Because if you receive some cash as advance, which you have to record as a liability, not as an income, because still you didn't perform that obligation to the customer. So that's why it is directly linked with the accrual accounting principle. Let's look into some example or corporate scenarios. At the year end, your company has consumed utilities worth 50,000, but the bill will arrive next month. So what you will do? At the end of a month or end of the year, your company is consumed a utility worth 50,000, but the bill will arrive by next month. So in this case, you have to record your liabilities as accrued liabilities. What is the reason? Because this expense already incurred and the obligation is exist. Now let's look into this scenario. Your company purchased raw material on 30 days credit. What you have to do? Still you didn't pay it because it has the supplier offered 30 days credit for you. So what is the action? You have to record account payable immediately. That will increase your current liabilities. So what is the reason for this? Delivery create a present obligation. If the supplier delivered as something which is creating a present obligation because it's a liability. Then a contingent liabilities case. A legal counsel estimates 70% chance of losing in a lawsuit. The expected loss is 500,000. So what is the action required? You have to record liabilities, and the reason is because it is probable and estimatable, because there is a 70% of chance to losing that case. and it is estimatable also. 500,000 is already estimated. So if you meet this criteria, you have to record this as liability. Now let's move into classification of liabilities. The key classification categories: current liabilities and long-term liabilities. Current liabilities are those liabilities which are expected to pay or expected to settle within 1 year. And long-term liabilities are those liabilities which is not expected to settle within 1 year. The current liabilities are going to affect the liquidity position, and the long-term liabilities are affecting solvency position. The key examples for current liabilities are accounts payable, accrued expenses, and unearned revenue are the part of current liabilities. The long-term liabilities are bond payable, long-term loans, and lease obligations are long-term liabilities. So it is based on the time frame, on which time frame we have to settle these liabilities. If it is we have to settle within 1 year, it is current liabilities. And if it is more than 1 year, the settlement period is more than 1 year, it is long-term liability. So the total asset will be, the formula for total liability will be current asset. The formula for total liabilities are, current liabilities plus long-term liabilities. There is a special thing you have to remember here. The long-term loan has a repayment due if some portion of long-term loan is the repayment portion. Suppose the current portion of long-term debt is considered as there is a special rule here. The current portion of long-term debt is considered as a current liabilities. Suppose the long-term loan payment due within 1 year, that portion is considered as a current liabilities, and the remaining portion is considered as a long-term liabilities also. Here is some critical insight, that means unearned revenues is always treated as a liability until it is earned. Then the contingent liabilities, if it is probable and estimatable, you have to record that as a liability, and if it is reasonably possible, you have to disclose it. And if there is any remote chance, that you have to ignore it. The common mistake that happening while liability recognition, treating advance payment as revenue and ignoring accrued expenses, and misclassifying current versus long-term liabilities, and not adjusting current portion of debt. These are the common mistakes that normally happening to students. So please remember these things. So before winding up this discussion, let's have a quick summary what we discussed today. It is about liabilities which is arising from the past event and which create a future obligation. Then to recognize something as a liability which require probability plus measurability. It should be probable and it should be measurable also. Then the classification of liabilities, the current liabilities and long-term liabilities based on its time frame. And the accrual accounting ensure proper expense recognition and creation of accrual accounting ensure proper expense recognition plus the proper recognition of liabilities also. Then the unearned revenue is a liability. Unearned revenue is a liability, it is not an income. Contingent liabilities, depending on the likelihood assessment, the recording or recognition of contingent liabilities is based on the likelihood of its assessment. So we have two multiple choice question here. The question 1, a consulting firm received 12,000 in advance for 6 month service contract starting from November 1st. What amount should be reported as a liability on December 31st? The total value of contract is 12,000 for 6 month contract. So the monthly contract value will be 2,000. If 1 month pass, you can recognize 2,000 as revenue and you can remove that from the liability. So here you can see the 2 months already passed, the November and December already passed. So you can remove 2000 into 2 to 4000 from the total liabilities, and balance amount you can recognize as liability. So in this case it is 12,000 minus 4,000. This 4,000 you are already recognized as revenue. So the balance amount is 8,000. 8,000 is the liability reported, should be reported on 31st December. Then question number 2. A company facing a lawsuit, legal counsel status, 40% chance of loss, estimated loss is 300,000. How should this be treated? Option A, record liabilities of 300,000, disclose in notes only, record expenses only, no action required. So in this case the probability is less because only 40% chance of loss and 60% chance there is a chance to win in this case. So it should be disclosed in notes only. No need to recognize as a liabilities in this case. So here the option B is the right answer. So this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.